Welcome back. Today we're going to cover capital investments. Every business have to invest money into capital in order to grow. So assets make more money, and more equipment you have, more companies you purchase, more company have opportunity to grow. Some companies do outgrow their growth and they might be improving in other things within a company. However, today we're going to be looking what it takes or what tools the company does have in order for us to be able to make good capital decision. So if you remember assets, liabilities, owner's equity, under asset section, we have a property, plant, and equipment, and we call it a capital, money you're putting into the business with hopes it will bring you more revenue in the future. All right. So we have a couple things that going on here, and typical capital budgeting decision the company would look into it. Should we lease or buy the equipment? I'm sure you have made that decision if you ever owned a car. Do you lease it or buy it? Do you buy a used car or a new car? Do you repair your current car? We always run into those decisions. Equipment selection. What volume of products we're going to have? Do you need a big capacity? I don't know if you guys coffee drinkers. I'm going to kind of go with assumption majority might be. But you walk into different coffee shops, you see different coffee machines, and some of them, some of the Starbucks have invested in very expensive machines. Somebody did the calculation there. What does it take to have a return on something like that? Plant expansion, they're working with a full capacity. Equipment replacement, it's too old of equipment. People don't want to come to our place. We're going to look at a car wash because maybe it doesn't do other features that are available with the other ones. And maybe to reduce a cost of operations as well. So capital budgeting tends to fall into either two broad categories. First is their screening decision. Does a proposed project meet some present standards or acceptance? I mean, are we even in the market for expanding this territory or interested in going in a certain markets? Do we want to expand and build a plant in South America, for example? Does the current laws allows us to do that? Then we have a preference decision, selecting from among several competing courses of action. So sometimes we might, once we decide to do something, what South America country should it be? Should it be Brazil, Venezuela, um, Chile? I mean, where should we go? Where's a product most likely to be maybe consumed? Why do we want to go to that country? And so on. So we're going to look at a couple of them. There's more methods out there, but those are what we're covering in this class. We look at the quick method. It's payback method. You guys are going to love it. It's really quick. It gives us good upfront information. We're going to look at net present value and internal rate of return. So simple rate of return method focus on incremental net operating income. And we're going to look at a cash flow that associated with investing. So let's take a look what happens to any project regardless what method we use. So initially, when you buy an asset, obviously, what do we have? Outflows, typical outflows. You can have repair and maintenance associated with a product. If you buy certain cars, every so many years you need to do something to them. I just find out they make cars without timing belt because my car was so old that I didn't even realize it's happening because I just changed my timing belt last year. Incremental operating cost. What does it take to maintain the current asset once we buy it? Initial investment, of course, that's the biggest one, right? What is it costing us to bring this into production or use it? And then we have working capital. Working capital, this is resources you can absorb right now, but they would be released later on back into your organization. So it's maybe shop floor where machine is on, maybe it's some people who will be involved with it, but working capital by definition is current assets minus current liabilities. But in this case, what is it that you're utilizing right now to run this particular project that later on, when the project is done, will go back into the business? Typical cash inflows for decision making. Salvage value, something you might be able to sell the asset in the end of its life. Sometimes you might have to pay to get the asset off your hands, but we're going to assume we're getting some money or none. Incremental revenues. How much more revenue would you be earning because of this investment? And then we have reduction of cost and release of working capital that I just talked about it. Now you have money coming back or resources, human power, into your business that were associated with this project. So, time value of money. I'm hoping maybe you had this somewhere along the line in your financial world, that classes you have taken, but we can all probably agree that going to the movies 10 years ago was somewhat cheaper than going to the movies right now. So the concept of time value of money with inflation, things cost more now. So the dollar worth more now, right? And as time goes on, the value goes down. So this time value of money, we're obviously gonna adjust it for inflation. You might have an expected rate of return that you're looking for. You would actually calculate things, assuming that things in the past cost less and in the future going to cost more. So let's say if I want to retire today, I would have to assume that when I want to retire in the future, let's say 20 years from now, whatever I need today would be inflated up to the level that would worth the money 20 years from now. And that's how we look at time value of money. You can probably, that's not part of this class, but I will show you. We're going to use the tables. You can use Excel for if you know how to use it, present value. We don't have to worry about future value calculation in this class. So I'll talk a little bit more about it. But as far as this concerned, that's something you can easily probably just Google it, a simple calculation. But we're just going to calculate present value in this course. And you don't have to use a formula. If you do have financial calculator or you know how to use Excel, feel free to do it. Otherwise, charts that come with the book work just fine. And I'll show you how to use them. Okay. Capital budgeting. It's a technique that best recognizes time value money and those that involve discounted cash flow. So we're discounting cash flow to present value. Okay. So the very first one, which not include present value, is a payback method. So payback method is focuses how long it would take us to project recoup initial investment cost, and we do completely ignore present value concept here. So what we do, we take an initial investment required divided by annual cash inflow, assuming annual cash inflow is the same. If it's not, what we're going to do, we're going to take initial investment and just chop little by little till we recoup all of it and say this is how long it took us to get the investment back. So if we have management of Daily Grind wants to install an espresso bar and restaurant that costs $140,000 and has 10 years of life, will generate annual cash inflow of $35,000. Management require payback period of 5,000. So companies would create some kind of rules what they're looking for before they make an investment or less. What the payback period for the espresso bar would be. So all you need to do is take your initial investment of 140 divided by 35. So it's 4 years. Therefore, it's less than 5 years. And it would meet requirements of this company. So it's relatively quick way of looking at how long would it take you to get your money back. Again, no present value. And this is a good method to use to do initial evaluation of projects when you're looking at a couple of them before you incorporate present value. This way, in case if you have too many options, you can quickly figure out which one works. Shortcomings, ignores time value money, ignores cash flows after payback period. So what if after 35 they suddenly making 90,000, but you turn down the project that only doesn't pay back in 5 years. Shorter payback periods does not always mean more desirable investment. Strengths, screening process really quick, identifies product that recoup initial investment, works really well for those cases. Okay, when uneven cash flow, I kind of mentioned that before, but instead of doing division, what we say, okay, year 1, we recoup 1,000, year 2, 0. So year 3, 2,000. Now we recoup 3,000. So you have to do year by year. Year 4, 5,000. Year, no, it's not 5,000. Sorry. 1, 2, 3, 4,000. 4,000 plus 500, 4,500. So you're going to actually subtract till you get to 0. And that's how you know when you recoup your investment. So let's say 4,000 project initial investment 4,000 and provides uneven net cash inflow. So in the year 1 through 5 shown below. So investment would fully recover 1, 2, 3, 4, So it would recover in this year. So in this case, recovery year is 4. So you cannot use a formula in this case. You would just have to go year by year till you hit the year when the recovery came. Okay, that's present value. Uh, so there's a couple things here. I went into your book, and if you go to your book, we have news coming. So in your book, you have two tables: present value of $1, and you have a present value of annuity. We don't need a future value for this class because we're going to bring every project to today's date. This way we can make sure we can make a good decision. Because you might have a project that is out 10 years and some machine might be buying for 7 years. How could you compare it to? Well, if you bring everything to today's day and see what is the value of it today, that would work the best. So this is how it works. Present value of $1 is what $1. So let's say I invested money. I'm going to use my kids as example. Let's say my kids want to go to college, and I have an uncle who is really rich, and they say, your kids are doing really good. Why don't I put a certain dollar amount in their account, and they will grow, and let's say they graduate in 5 years from now, they'll have so much money. So we're going to say, okay, how much do you need 5 years from now? So X dollar amount. So he's going to give me the money, and then we're going to discount the money, let's say 5 years from now, and let's say we can earn 7% on the market, right? So I say, okay, we need 50,000 5 years from now. So we're going to take 50,000 times 0.0713. And this is how much we need today to invest. So I'm going to do this quickly. 50,000 times 0.0. I don't have a rich uncle, by the way, but that's a good idea to have just for the sake of example. So 50,000 times 0.713. So I need to invest $35,650 today. I'm going to do nothing with that money. And in 5 years, under 7%, I will have $50,000. So it's single dollar amount today going in the future. Now, let's talk about annuities. With annuities, right? You're going to make a payment every year and say, okay, your kids are doing great, but I would like to make a payment every year just to make sure they keep doing good at school. So instead of giving you one lump sum today, I'm going to give you a payment for next 5 years, right? Make sure that, they have enough money. So now I have 5 years at 7%, 0.41. And obviously we have to have a payment portion in here. So I don't know how much is he going to give me. Let's say he's going to say, I'm going to give you $10,000 for next 5 years, right? So if you give me $10,000, it's annuity. It happens on the payment basis. And by the way, period doesn't have to be 5 years. Let's say it's every month, so 12, right? Let's say if it's every month, it's 12. Let's say for 2 years, 24. So now it's a 24 period, but this is interest you're earning per period. So 7% would be really high in this case to earn per month. I don't think it's even possible unless if you're a very highly inflational country. So let's just go back 2 years. So let's say every 5 years, he's going to say, okay, every year I'm going to give them $10,000 for next 5 years, and then we're going to still earn 7%. And my question is, how much money would I have in 5 years from now? So I'll take my 10,000 times 4.1, and I'm going to have $41,000. So it's annuity, and it makes sense because even though you say, well, wait a minute, no, it's a present value. So I'm taking this back. On today's money, we have 41,000. So it's a present value. So we take 10,000 times 4.1. So on today's money, right, that $50,000 worth only 41,000 today, right? So we're not calculating future value, what it's going to worth. So today's money, payment for next 5 years at 10,000 times 0.41 worth $41,000. And that's my present value. So 2 tables, annuity, word annuity here, make sure you pay attention to that. And you have a single amount when he invested only once. So that's your little lesson on present value calculation. All right. So net present value method compares the present value of project cash inflow with the present value of cash outflows. So we talked about inflows and outflows before. The difference between those two streams of cash flows is called the net present value. To simplify assumption, we always assume all cash flow other than initial investment occurs in the end of a period. So that 10,000 would be like in the end of a year, not in the beginning of a year. Okay. All cash flow generated by an investment project are immediately reinvested at a rate return equal to discount rate. So that's 7%. And let's just look at example. And please, again, piece of paper, have a piece of paper, pencil in your hand, write it down, make sure you can calculate everything yourself before we go any further. Okay, so that's what we're dealing with. Lester Company has been offered a 5-year contract to provide component parts for large manufacturer. So cost of special equipment would cost $160,000. Working capital required. So this is capital that they're gonna take to absorb from the company. They're gonna take $100,000 today, and they're gonna use it on this project. They're gonna realign equipment in 3 years. It's gonna cost them $30,000. Salvage value of equipment in 5 years from now is $5,000. We have annual cash revenue and cost. So we have sales revenue from part $750, cost of parts sold $400, and salaries of shipment is $270. So let's talk about single payment versus annuity. Cost of special equipment $160, present value equals to $160. It's on today's money. Working capital, right? Working capital. They're working, and we're going to have additional information. It's on today's money. This is what you're spending, but that's money going to be coming back to you down the road after 5-year contract. So it's a single annuity, single payment, scratch that. It's a single payment coming back to you, the working capital, on today's money when you're going to release that 100,000. So you're going to use working capital twice. First today at 100,000, then a single amount coming back 5 years later will be released, and you can use that money today. Realigning equipment in 3 years. You're going to do this once. Because you're doing this once, it's a single payment. Salvage value of equipment in 5 years, $5,000. Again, that's money they're going to get back 5 years from now, right? So we're going to bring it on today's day, and you're getting to sell your equipment only once. So it's a single amount. Now, all of this, because the word says annual, it's annuity, right? So it's annuity. So every year you're going to generate the revenue. So at the end of 5 years, working capital will be released. I mentioned that before. And Lester Company uses discount rate of 11%. Should contract be accepted? So we're going to use this example to learn how to calculate this. All right. First of all, we're going to simplify our life a little bit. Instead of having every single item, we're going to say revenue minus our expenses. This project will bring annual net cash inflow of $80,000. So again, it's annuity. It's happening every year. So how are we going to build this out? Investment in equipment and us capturing working capital. This is shop for space, maybe people I'm utilizing, maybe money I'm using for this project that would obviously be released later on. But their today's money worth $260,000, and the factor is 1 because we're not discounting for inflation or factor. Now, annual net cash inflow. Remember, from year 1 to 5, we have 80,000, right? And it's 11%. So let's go back to our wonderful chart here, and we say annuity. So this is present value of $1. Not good. We need annuity. So we're going to say 5 years, 11%. So this is a factor we're using, 3.696. It came right from the chart. Okay. So we're using 3.96. So that 80,000. So if I take 80 times 5, right? Don't need a calculator for that, but $400,000 equals to $295,680 on today's money. So $400,000, 80,000 times 5. That's a lot of money, but at 11% today, it's worth $295,680. We bring everything on today's day. Now, realigning of equipment. In 3 years, I need to spend $30,000. Remember, it's a single payment. So let me go back out. I'm going to go back out here. And this is single payment. So 3 years from now, 11% right here, 0.731. This is where that number comes from. So on today's money, 11% at 11%, 30,000 worth like 21,930. All right. Now, salvage value of equipment using the same chart I just did of single dollar value is 0.593. So period 5, 11% factor. $5,000 and $100,000 would worth $2,965 and $59,300. Do you guys see that capital I'm releasing doesn't worth the same? You are losing value. If I'm going to borrow $100 from you and give it back to you 5 years from now, you would want more than $100 because what you can do with that $100 now and what you can do 5 years from now, it might be very different. So now something present value to release working capital and the salvage value of equipment 62 to 50. It's total between those two. That's money coming back to us, right? We didn't sell equipment. Well, we did sell equipment for 5,000, but capital gets released. So now this present value of a project is 76,015. Something to mention, this is already includes 11% return. So it's a big yes to accept this project. We'll accept everything with 0 and above. Even if it's 0, we're still getting 11% return on this project because we build this model with 11% in mind. So this is net present value method. Okay, we're going to evaluate the acceptability of investment project using internal rate of return method. An internal rate of return method is a rate of return promised by investment project over a useful life. It is computed by finding discounted rate that will cause net present value of a project to be 0. So we're kind of aiming for 0, but we try to figure out what internal rate of return is. So it's kind of reverse what we just did because information you give it. It works very well if a project cash flows are identical every year. So we had 80,000, 30,000 outflow. We had different things going on. In this case, we're saying, hey, we have very identical maintenance and everything else. If the annual cash flow are not identical, the trial and error process must be used. And that's a hard part. So some students said they used Excel and it worked really well for them, but trial and error is your key. So if it's equal or greater than minimum required rate of return, we're going to accept the project. If less, we're going to reject. So companies would have rules what they're willing to accept for what projects. Any friend the same, what are they willing to accept for the company that they would bring in if they bring something existing and just rebranding and so on. When using the internal rate of return, the cost of capital acts as a hurdle rate that a project must clear for acceptance. So we have to kind of prove we can do it. Let's look at example. Decker Company can purchase a new machine at cost of $104,320 that will save $20,000 a year in cash operating costs. The machine has a 10-year life. So for me to figure out what is my present value factor for the internal rate of return, I would take my investment divided by annual net cash flow, right? And remember, this is a 10-year. So 5.216. Let's go back to our chart here. And this is annuity because it's coming up every year, 5.216, 10 years. So I'm going to keep going. Here we go. It's a 14% internal rate of return. So we're kind of doing the same thing, but in return. We know what the return, how many years it is. We know what the return is, but we don't know the percentage. So I know it's 10 years. I know it's 5.216. Now I just found out my percentage. All right. And that's kind of the part of my chart, but I wanted to go to your original one. So if Decker minimum required rate of return equal or greater than 14, they will accept this project. That's simple as it is. Net present value often simple to use. Question of assumption, obviously the cash flow is the same, and internal rate of return method assumes cash are reinvested in internal rate. So whatever is coming in, going back in and reinvested again. If internal rate of return is high, this assumption may be unrealistic. it's more realistic to assume that cash flow can be reinvested at the discount rate, which is underlying assumption of all net present value methods. All right. Let's look at total cost approach. We have a car wash and we have two options. We can remodel an old car wash, or we can remove old car wash and install the new one. The company uses a discount rate of 10%. So it happens a lot of times. Do you repair that car or do you buy a new car? What is the present value of this project? So we're looking at two alternatives, and obviously the one that has the highest present value you would consider in this case. So this is what else we know. If White installs new washer, and by the way, you're not considering the time you have to maybe shut down to build a new washer. Maybe repairing one shuts you down for just one weekend, and building one shuts you down for 3 months. So there could be other things that we're not considering here, but we're assuming it's the same situation of repairing it and building a new one. So the cost is $300,000. Productive life is 10 years. Salvage value is $7,000. Replace brushes at the end of 6 years, $50,000, and salvage value of old equipment is $40,000. So the old equipment, because we're getting a new one, we can still sell. So if we calculate present value and we use a 10% factor, like 6% of replacing brushes of single amount is 0.5646, interest 10. And this is a good time when you maybe stop the video and say, hey, this is awesome chance for me to practice. Why don't I try to calculate this myself and come up with Ms. Labrizi's net present value and make sure I understand where numbers are coming from. So if we replace the new washer, right, we will get a net present value of $83,202. Now, if we remodel, my remodel cost would be $175, and I still have to replace brushes at higher cost because it's older machine. It's 6 years from now at $80,000. So now I'm going to take initial investment at 1. I'm going to take factor for a 10% 6 years from now. So 80,000 really worth only 45 today, 45,120. And annual net cash inflow is 45,000. Therefore, my net present value is 56. So you can see that getting a new washer is better than remodeling the old one. So in this case, right, in favor of new washer is 26,797. But for us to compare those two awesome proposals, we needed to bring everything to today's day. There were really two different projects dealing with the same location, the same place. And it's a cool way of approaching it. You can have more than two alternatives. You can have 3, 4, 5. Obviously, you want to narrow it down where it's reasonable to look at it. Least cost decision. In decision where revenue and not directly involved, managers should choose the alternative that has the least cost. And you're not always going to have that revenue to look for the positive present value. So, for example, home furniture company is trying to decide whether to overhaul an old equipment truck now or purchase a new one. So maybe it doesn't bring revenue. My car doesn't bring me revenue. Gets me from point A to point B. So old truck, we have overhaul costs $4,500. It costing us $10,000 to run it. $250 salvage value in 5 years, and salvage value now, if I sell it now, is $9,000. If I buy a new truck, I'll get it for $21,000, and look at that. My annual operating cost going down from 10 to 6 because it's a newer truck. And 5 years from now, I'm going to be able to sell it at $3,000. So if again, I calculate present value calculation using annuity for annual operating cost and single value for the rest of them, and annuity again for this one, I can see that buying a new truck has the least cost, right? So we're looking at the least cost. So both numbers going to be negative. Remember we said we're picking the best project. We're looking for revenue, but there's no revenue stream here. I mean, yes, we're selling it in the end, but it's one of the assets, unless if it's an antique car or a collector's car. In this case, we're using it for the work project or to generate revenue is not the case. So in this case, the least cost would be preferable, which in this case, $32,883, and it wins by having $9,372 cost savings. So next time you're buying your car or thinking of, evaluating between buying two different cars. I had one class, we looked at a hybrid car versus a regular car, and we looked at cost. Something you can evaluate, insurance cost changes based on what car you have. So you can really get in the nitty gritty details. Have fun with that. But you can really build interesting models for yourself of choosing one project versus another. And you have awesome tool under your hands now. All right. Learning objective 4, we're going to evaluate investment project has uncertain cash flows. So in this case, we're dealing with a tanker. They are expensive. We did look this up once with my students. So it's a super tanker. So we're going to assume that we're going to use it for 20 years, and we need to see for this investment to be worth a while for us, what is it gonna, what are we willing to accept 20 years from now? So it's 20 years from now, but we need to bring it on today's day. So using discounted rate of 12%, management has determined the net present value of the cash flows except salvage value is negative 1.04 million. So we have 1.04 million. So we need to bring it on today's day to bring it down to zero to determine what we're willing to expect it for salvage value. So what we need to do, we have 12 years, 20 return. So we're going to go and we're going to look for 20 years, 12%. And by the way, this is a present value of single amount because you get to sell your tanker only once. So 20 years, 12%. So we're looking at 1.04. So we need to see what is 1.4 million. 04 million would be on today's day for us to be able to determine that. So we're going to go back to a present time PowerPoint. So we're going to look at net present value to offset 1.40 million divided by present value factor we just found on the chart, right? 0.104. So we need at least $10 million for super tanker to be offset the current cost to get a 12% return. So that's a cool way of doing this. Okay, the next one, we're going to rank investment projects in order of preference. So we're going to screening decision pertain to whether or not some proposed investment is acceptable. If decision comes first, and then we have preference decisions, attempt to rank acceptable alternatives from most to least appealing. So sometimes we can accept couple decisions. You say, oh, I want to go to vacation to couple spots. I can pick only one. But what if you can, out of 4 options, pick 2? So now you're going to rank which out of those 4 you can pick. Internal rate return method. We're going to use internal rate of return method to rank competing investment projects, and preferences rules is the higher the internal rate of return, the more desirable the project would be. The net present value of one project cannot be directly compared to the net present value of another project unless investments are equal. So going to Africa would be different than visiting somebody in Florida. So the investment in a project cannot be compared. I mean, obviously, there's maybe emotional and other interesting things that you can gain by visiting another country versus having a trip here in U.S. All right, let's say we have project A. We have net present value of 1,000, the same as net project B. However, investment for project A is 10,000, but B is 5. So profitability index is 10%, and here's 20. The higher profitability index, the more desirable project would be. So we're taking net present value divided by actual investment. So that's the next step. So if we have to rank those projects, right, obviously project B would be more desirable. How do we complete simple rate of return? We take annual incremental net operating income and we're going to divide it by initial investment. Should be reduced by any salvage value from sale of old equipment. So you're going to, if you like that washer example we had, sale of the washer would be actually reduced by initial investment because you're getting that money back. So management of Daily Green wants to install espresso bar and restaurant. We kind of saw that before, but this is coming back in a different way. Cost is $140,000, 10 years, will generate incremental revenue of $100,000 and incremental expense of $65,000. So It's going to go up by that amount. So 100 minus 65, we have 35,000 increase in overall net income for the year. What is our simple rate of return? So we're going to take a 35 divided by 140. So my simple rate of return is 25%. Shortcomings: ignores time value money because we just took investment. We did not look at a present value. Same project may appear desirable, the same thing, but undesirable in other years. When investment center manager are equivalent using return of investment, which we done it before in this class, the project's simple rate of return may motivate them to buy best investment opportunity to earn positive net present value. So you do, if once you pick a project, would be nice to run the numbers. Now, this is very important. Post audit. You have to follow up after the project has been completed to see whether or not expected results were actually realized. I have seen so many companies have estimates. Oh yes, the sales going to go up by 35,000, but what if they didn't? Should you continue with this project? What if the sales went down because the quality of product you're reproducing now with a new machine is not the same? So once a lot of times we convince management to do the project, we want to make sure we follow up and make sure the results you're expecting. The brushes got changed. Do we put it in the budget, $30,000 brushes to be changed in 3 years from now? Things like that. What is the audit? Okay, machine is not working as we wanted, but we did not include certain costs we didn't realize going to include in that. So we can maybe go back and reevaluate as we're doing new investments and learn from them. And this is it for this chapter. So it was a pleasure to be here for you for this learning experience. And I hope you learned a lot. And if you have any questions, I'm here for you. Please reach out, and great job. This is a lot of learning, and hopefully you can apply it in real life.